Good afternoon, everyone. Thanks for taking your valuable time attending this webinar. Great to see such a huge response to this popular event. My name is Kevin Zhang. I'm the Compliance and Technical Service Manager at CLAS. Joining me today is Senior Support Analyst Shasha. She will be assisting me answering any questions during the session you may have. A few housekeeping items. Copy of the PowerPoint slide and case study summary should be emailed to everyone before this webinar. In case if you have not received this email, they can also be downloaded during the session. Recording of the webinar will be made available to all attendees at the conclusion of this webinar series. It will be roughly mid-August. Despite my reluctance, the marketing team will also upload the video through CLAS YouTube channel, as well as linked through the CLAS user guide. The format of my presentation will be roughly 25 minutes content, 25 minutes case studies, and 5 to 10 minutes will be dedicated on question and answers. Now, I would also like to take this opportunity to say thanks for everyone who left feedback at the end of the webinar last time. Please continue to do so. I have received overwhelmingly positive as well as some negative feedback, which I equally cherish them. So lastly, one of my favorite catchphrases, which summarizes the real intention or purpose behind those webinars, that is educate and dominate. Hopefully you can learn a few tricks and tips from my session. Go back to your practice to be the power users in class with fountain of knowledge, where you can teach and share with your colleagues on some of the industry best practice, handling the exam current pension income, as well as the actuarial certificate changes. Let's get started. Quick disclaimer, the information provided today is general in nature and should not be relied on as an advice. Some of the features and functionality may change over time and improve as we have taken into account some clients' feedback and suggestions. A quick overview. I will go through the legislative changes as well as some of the new terminology, how CLAS has implemented those changes. Then we will dedicate a few minutes on different actuarial certificate scenarios. Then we'll start case study number 1, which relates to disregard small fund assets. Case study number 2 is to do with whether you want to use elected segregation or segregation for investment choice purposes. Case study number 3 is to do with a simple trees conversion. Then we'll go through a more comprehensive example of a complex trees conversion that led the fund becoming deemed segregated. Lastly, we will provide some useful references, as well as mention the CLAS Connect conference. And if time permits, I will go through some questions as well. So most people is already familiar with this change. From 1st July 2017, transition to retirement income stream loses tax exemption status on earnings. So what does that mean in CLAS? So TRIS account can no longer be assigned to a pension pool account, pension pool structure. Period updates now allocate tax expense against TRIS account similar to an accumulation interest. It will not count towards claiming exempt current pension income, and 50% tax will apply to the earnings supporting TRIS. The next bullet point is to do with disregard of small fund assets. This is when, as at 30 June previous financial year, if a member was in retirement phase and had a total super balance over $1.6 million, then in the next financial year, the self-managed super fund has a member in retirement phase during the year. The fund cannot use either the elected or deemed segregation method to calculate the exempt current pension income. The last bullet point is not really a change in the legislation. Rather, it's a new interpretation by the ATO on how actuarial certificate should be applied. So the 2017 and prior, those approaches are grandfathered. Fund must use segregated method to calculate ECPI if it's in full pension phase. Actuarial certificate now only covers the period when the fund is unsegregated. So I will briefly show you an example how this is applied using the new interpretation. The next slide is dedicated to some of the new terminology. So the first one is called elective segregation. Some people in the industry also refer as actual or active segregation. So this means for self-managed super fund, there are certain assets that are specifically set aside to support some or all the current pension liabilities. Then there's a concept called deemed segregation, also known as de facto segregation. For a self-managed super fund that is eligible to use segregated method in a given financial year, if at any stage during the financial year, there are periods where an assets are solely supporting the retirement phase income streams, then those periods are deemed to be segregated. So the reverse is effectively deemed unsegregated or unsegregated period. So this is normally implies when the fund was either in full accumulation phase or mixed mode when the assets are supporting both the accumulation and retirement phase interests. The lastly is TRIS in retirement phase. So for TRIS in non-retirement phase, if they satisfy a new cash restrictions, conditional release, such as age 65, retirement, permanent incapacity, or terminal illness, then the TRIS effectively will convert to a retirement phase. So you lose your 10% maximum drawdown restrictions. It start receive tax exemption on earnings. It become reportable for TBAR purposes, and as well as including in part of ECPI calculation. So I provide a summary table explaining the difference between TRIS in non-retirement phase and TRIS in retirement phase. So apart from the 10% drawdown and the lump sum restrictions are lifted, the earnings on TRIS in retirement phase will be generally unrestricted and tax exempt. It will also increase, for the purpose of calculation, the actuarial pension exemption percentage. And obviously, for TBAR purposes, it's reportable as a credit balance. Now, this example, I will quickly show a simple 100% pension fund with balance of $1 million received contribution, both concessional and non-concessional, of $125,000 in 4 equal installments. Then the graph basically display below that in the old world, you just need to work out 1%. Where you can see the light green area, that's the period when you receive the contribution for a period of roughly 1 month. And the remaining gray area is the retirement phase area apportionment. So if you go obtain a actuarial certificate before 2017, you will get 99.065%. Here's the new world. So as you can see, if I made a contribution on 1st August and wait for the month, start a pension on 1st September, then I'll do that in November, February, and May, 4 different months. Then you can see the fund is effectively changing from deemed segregated period to unsegregated period, and that happened 8 times. So during the year. So for the 4 months when you have the contribution and sitting in accumulation interest for 1 month, you have to use segregated method to work out. Sorry, you have to use the actual percentage method to work out the percentage for that 4 months. The remaining 8 months, you have to use segregated method. So as you can appreciate, the calculation of the exempt current pension income become a lot more complex in the new world. Not only that, when those boundary condition happened, you have to report the day it happened, as well as the balance in the retirement phase to the actuary. So in this example, the ECPI is 97,172, but it's only applicable to the 4 months where I have the contribution income. Now, how has class implemented those changes? So I already touched base what the industry practice has been previously and what we're doing currently. So I will just go through the next few bullet points. To start with is fund policies. So generally, you only need one fund policy for one financial year, and that's still the case in the new world. Previously, before 2017, there's one edge case you can have 2 fund policies. That's one a fund is changing from a 0% to 100% pension phase. So, and then you can say if it happened on 1st January, so you put a 0% from 1st July to 31st December, and then the second fund policy start from 1st January to 30 June with 100%. So this is one a member entire balance with initially in accumulation, then retired and put everything into retirement phase. In the new world, the system is smart enough to pick the boundary conditions, and you don't need to do the 2 fund policies to reflect that structure. I will show that in my case study, an example how does actually work. Period updates. Now, previously, if you run period updates throughout the year, provide the last period update, you have the official actual percentage from the actual provider. Rerun last period update, it will automatically fix your ECPI calculations. In the new world, you need to review both the exception reports. Exception reports has been improved to capture a lot of, to warn you about a lot of the boundary condition changes, things like changing from segregated to unsegregated or trees conversion. Then the period update algorithm has been improved significantly to warn users about those boundary conditions, and it will prompt you to run the period update the day before those boundary conditions changed. I will show you in an example in my case studies as well. Capital gain, again, previously, if you only get 1% for the year, the capital gain is included in your ECPI calculation, but it will be reduced by the pension exemption factor. In the new world, if you have multiple periods when the fund is deemed segregated, the capital gain in deemed segregated period are completely disregarded. It's only from the unsegregated period you have to include. Actuary certificate integration. Because of such significant change, class have been working very hard with all our actuary providers. As you can see, a lot of additional information we have to send to the actuary certificate payload, including those dates when the boundary condition happened, as well as the balances. So far, there are 5 actuary providers already with that new payload that integrate with class. They are Accurium, Act2, Hefrom, Line, and Veris. The other 2, once they upgraded their systems, should be ready to use the new methodology. However, if they request an actuary certificate for 2017 and prior, that should be fine, and they will be still using the old payload and old methodology, and that part has not changed. ECPI income. So I already touched base that the ECPI calculation now becomes a lot more complex. Previously, if it's only get 1%, you have your assessable income less your contribution, less your non-arm's length income times the actual percentage. Now, you have to work out the ECPI attributable to the segregated period plus ECPI attributable to unsegregated period. Then you add those numbers together to work out the total ECPI. Because of the changing methodology how ECPI is calculated, there's a flow-on effect on the pension exemption fund expense percentage calculation class as well. So I will go through that in my case study number 4 in more details. And lastly, the annual return, particularly Section A, Question 10, to do with the exempt current pension income. Previously, if you get a trust certificate, you were just using unsegregated method. And now, because if the fund's switching between the two modes, you have to state it's using both segregated as well as the unsegregated method. The next 6 slides I'm dedicated to explaining some of the common scenarios. And sometimes you need a trust certificate, sometimes you don't. The purpose of that is to illustrate how easily a fund, because what happened during the year, simply starting a pension, stop pension, or roll out, can make a fund become deemed segregated. So the first scenario, 100% accumulation, same as before, you don't need a trust certificate. This one, 100% pension, but it's under the 1.6 million threshold. It's all in retirement phase. Again, you don't need a trust certificate for this scenario. Next one. Simple mixed fund, you have 400,000 in accumulation, $1 million in pension. You get one trust certificate for the year, same as before. This one, the fund start with initially $1 million in retirement phase. On 1st of September, it received a contribution plus rolling of $400,000 into this super fund. Then for the first 2 months, it's effectively a deemed segregated period, and the remaining 10 months, you need an actual certificate. Mixed fund, this fund, they had 400,000 accumulation, $1 million in pension, used 400 to start another pension. Then the first 2 months, you need a true certificate. The remaining 10 months, it's deemed segregated. 100% accumulation commenced a partial retirement phase income stream. As long as you have any amount in the accumulation interest throughout the year, generally you just need one actual percentage for the year. So one way to effectively avoid deemed segregated state is to have a small balance sitting like accumulation interest. As low as $10 is sufficient for these purposes. Then you have mixed fund member exhaust the balance by rolling the 400,000 out to another super fund, or as a result of divorce settlement. Then the fund for the first 2 months, it's actual percentage, and the remaining 10 months will be deemed segregated. Trust conversion, but continue to have accumulation interest. In this scenario, you just need a 1% for the year. This one is a trust conversion. So member turns 65 on 1st of September. So in this scenario, you don't need a trust certificate. So the first 2 months, the fund is effectively in 100% accumulation. So that's a 0%. And the next 10 months, it will be 100% in retirement phase. Therefore, it's 100%. So in this scenario, you do not need a trust certificate for it. Our case study number 3 will go through the example. The next one, then you start with a retirement phase income stream, received contribution and rolling of 400,000 on 1st September, then start pension 1st February. You effectively have deemed segregated actual percentage and deemed segregated again. This is the flip side. So you start with a mixed mode. So you need actual percentage. Then you exhaust the pension balance by using the money to start another income stream. Then on 1st February, you received a contribution or rolling of 200,000. So to apply, you need the actual percentage, deemed segregated actual percentage. The last one, so this is a trust conversion during the year, and the 400,000 was used to start another pension on 1st February. From 1st February to 30 June, that 4 months, it's effectively become deemed segregated. The first 8 months, you need an actual certificate. Okay, now comes the fun part. We're actually going to switch into class application. We're going to go through some of the case studies. Now, if you have the case study handouts, open that PDF or print it out. So I want to show you the PowerPoint slide part in relation to those case studies. Okay, The first case study is the Paw Patrol Super Fund. Now, this fund, as at 30 June 2017, Mr. Chase Patrol had $2.5 million in the pension, in the super fund, with $1 million in accumulation and 1.5 in retirement phase pension. He has received an estate planning advice to basically set up another self-managed super fund so that he can retain the 100% tax-free components in this current super fund, and the $1 million will roll out to another self-managed super fund with the 100% taxable component. So he processed rollout roughly on the 15th of July. So I already processed that in class, and so obviously when you do a rollout, you need to do a peer update to the date before the rollout, so 14th of July. Process rollout on the 15th of July. From that point onwards, the fund effectively become deemed segregated. Then you run a peer update to the end of financial year. Then the next part we're going to do is actually go request an actuarial certificate. Now, because this fund has 2.5 million as at 30 June 2017, it falls in the definition of disregarded small fund assets, and therefore it cannot use segregated method at all to work out the ECPI. So this question, can you use segregated method for this fund in the financial year? Class will automatically default to no in this scenario because they have 2.5 million as at 30 June as an opening balance effectively. Click next. So as you can see, because it's a used proportional or unsegregated method, the light green area is effectively the non-retirement phase, and the rest is in retirement phase. So you should see a very high actual percentage as a result of this. Click next. And the percentage is 97.507. Then if we go through the payment and completion, this provider will send both the certificate and the percentage back to class. Then as long as you rerun the last peer update, that should be end of processing for this fund. However, the reason I want to illustrate this case is that we actually had a customer raise a support issue about this. So what they did is one of their less experienced administrator, because she only looked at the pension balance at the end of financial year, which is they only have 1.5 million left, and she incorrectly assumed the fund is eligible to use segregated method. So what she did was this question, she overwritten that question from a no to yes, and then proceed to request an actuarial certificate. By doing so, the actuary will only work out a percentage for the first 2 weeks, i.e. 1st July to 14th of July, with a percentage of 60%, because 1 million over 2.5, 1.5 over 2.5, that's 60%. And the remaining is effectively deemed segregated. And click next, and that's the percentage. Now, 60%. And that percentage is sent back to class because the whole fund was processed. The last year's 2017 was processed on class. So the class knows it's got total super balance over $1.6 million. So it cannot use segregated method to work out ECPI. So it's always using proportional. Therefore, and the only percentage they had in this fund was 60%. So by doing this, it was understating their ECPI income by the factor of 37%, the difference between 97 and 60. And it was only picked by the auditor who reviewing the actual numbers and noticed the ECPI was significantly lower than what they expected. So going forward in class with this member, you need to make sure, because the $1 million is in another super fund, you need to update under contribution cap area, and that's where you put external super balance for $1 million here. Then system will take into that account, and then it will apply the correct method to the ECPI calculation. So that's my case study number 1. Number 2 is another common scenario we get a lot of queries for. So case study number 2 is the Little Kingdom Super Fund with 2 members. Ben has $1 million in retirement phase, and Holly has $400,000 in accumulation phase. Both members has their total super balance less than 1.6. Therefore, it's eligible to use segregated method to work out the ECPI. Now, we got questions about how you actually do segregation in class. So I'll quickly show you. If I can find my cursor. Okay. Okay, you go investments, browse holding accounts. By default, everything will be in a default pool, and there's no segregation. So to do segregation or elect a segregation, you need to set up asset pools. So you go to maintain asset pools. It's always best practice to have new asset structure per financial year if you're doing segregations. So I will call that elect segregation. Save. Now I got 3 member accounts, and the pension is the one we want to do the segregation. In terms of investments, we want to segregate one of the cash account, which is CBA, as well as the property to Ben's pension account. Okay, let's tick this. Move selected. We'll create. The first thing is actually create a pool. You want to create a new asset pool. And do you want to create a pension pool? Say yes. So that's done. Then you move the holding accounts or investment account to that pension pool. I want to move to default pension pool. Move. Okay. Now go back to summary. You can see this pension pool with 1 pension account and 2 investment account, which is the cash and the property. Okay. So that's part 1. You have to actually do the asset segregation. Part 2 is actually make sure the fund policy is changed so that you have this tick box, asset segregation for pension purposes, set to yes. Then you don't need to enter a true percentage. So that's correct. Save that. Now in my example, I have rental income of $26,000 being $500 per week times 52, and $6,000 interest income that segregated to Ben's pension balances. So because you choose elected segregation, you do not need to obtain an actuarial certificate. We will just do a period update. To the end of financial year. Then we just check the numbers. There's a couple of ways you can check the numbers. I will quickly show you 2 reports. The first one is investment income summary report. Now, one of the options you can do that is group the invest summary income report by asset pools. Preview. You can see the default pension pool. There's my $26,000 rental income and $6,000 interest from the bank, and the rest belong to the default pool, which is Holly's share of income. Now, if we want to check whether the ECPI is calculated correctly, let's run the statement of taxable income report. You should see 32,000 be part of the exempt current pension income. So that's your exempt current pension income, and that's your total 32,000, 6,000 plus 26,000. So this is how you do segregation, elective segregation in class. Now we're going to move case study number 2B. So this is segregation for investment choice. This fund, the Wiggles Family Super Fund, has 2 members. Lachlan has $2 million, 1.6 million is in retirement phase, and Emma has 400,000 in accumulation phase. Because the fund has a member over 1.6 million, they're not eligible to use segregated or deemed segregated method to calculate ECPI. They have to get a true certificate percentage to work out the ECPI. Let's go to the fund. Okay. Now this one, I'll just quickly show you that I already set up fund structure. That process is similar to before. You can see the cash and the property both belong to the pension pool. And if we go to maintain asset pool, so when you have pension pool, you can assign one pension account or multiple pension account. It's up to you. So just to make sure, number one is the balance that the assets that you assign to the pension pool should roughly equal to the pension balance. So in my example, those 2 assets should add up to 1.6 million. So I had, I think, 1.5 and 100,000. Okay. The next thing we'll check is obviously the fund policy. Now, in this fund policy, provided this option, asset segregated for pension purposes, is not selected to yes. So what happens if you do select to the yes? I'll quickly show you what happens if you do that. You will get a warning in exception report. Sorry, it's just loading. Okay, here we are. So elective segregation. So the funds are ineligible to use elective segregation because their total to balance is greater than 1.6. Basically ask us to review and rerun peer updates. So provided you say no, you're effectively doing segregation for investment choice purposes. You still get a true percentage. So I won't go through how you get a true percentage in this example. But what I want to show you is the period update. In this example, I had a slightly higher rental income for Lachlan's pension account. I think it was $2,000 a week times 52, so it's 100,000 thereabout, plus the interest income. So if you go allocate benefit to members, the 110,000. So this is the 104,000 plus 6,000 interest, the made investment income that allocated to 2 of Lachlan's pension accounts, and they are allocated in proportion to their pension balances. So this is how so Lachlan's, his remaining accumulation interest is shared with Emma's accumulation interest in the default pool. And because they equal balance, they take a 50% each. So this is how you do segregation for investment choice purposes. Okay, let's do case study number 3. Case study number 3 is the fireman Sen Super Fund. He's a simple man, 64 years old, sole member of the fund with 1 million in transition to retirement income stream. Where's my fireman's there? Okay. Now, he turned 65 on 1st January 2018. If there are no additional contribution made through the year, then it will be first 6 months effectively you will have 0% because it's entirely being in TRIS mode. And once TRIS is converted to retirement phase, it will be TRIS in retirement phase, 100% tax-free. So if you run pre-update, now previously you do need to set 2 fund policies in 2017 or prior, but with the new change in class, the system is smart enough to prompt you. So the first one is about ECPI method changed to deemed segregated, and that happened on 31st December, just 1 day before he turned 65. So if you run pre-update, now the new way, you don't actually need to have 2 fund policies, and the system is smart enough to pick up the numbers. So we'll run a second peer update. Obviously, in this scenario, you don't need actual certificate. But what I want to show you is basically how to check the numbers. Okay. Now, again, my default report's always the investment income summary report. And this time I want to run the report from 1st July to 31st December 2017. And this is the period, remember, it's to do with the TRIS in non-retirement phase, and therefore all the income in that period should be taxable. And I got my $2,510. That's the income. Okay, I'll run exactly the same report for the next period. So 1st January 2018 to 30 June. So remember, this is the second phase where the TRIS effectively is in retirement phase, and therefore this income, $14,100, is effectively tax-free or fully exempt. Okay. Now let's run the statement of taxable income to confirm the numbers. So I should see there should be ECPI income of 14,100, and the net income should be 2,510 for the first 6 months, and that's exactly that. So obviously, when you fill in tax return, you'll be using segregated method to work out that ECPI. Okay, what happens if Sam actually did make a contribution for the year, and say he made on 1st of June 2018? So let's just process that. I already have that event processed, member contribution, but it's currently in incomplete state. So 25,000 concessional contribution or employee mandate, and then 100,000 non-concessional. Just submit that. You get a warning because it's in relation to pre-existing period update, modify event warning. So let's go fix that. Roll back. Yeah. Now, this time the system is smart enough knowing that when you made the contribution on 1st of June, the day before, which is 30th of May, the ECPI method has changed from effectively a segregated to unsegregated mode. So process that. Then you run the next period update to end of financial year. Obviously, if the fund at any state it's in mixed state, supporting both accumulation interest, being the contribution, as well as the pension interest, being the TRIS in retirement phase, then you need the actuary certificate. So I'll quickly show you when you go get the actuary certificate. Okay, now this question, because I have TRIS conversion, it will automatically pre-fill that question for you as well. If you click next. And this graph, or this diagram shows exactly what happened. The light green area is effectively the non-retirement phase. The first 6 months effectively is TRIS, and this is TRIS in retirement phase. And the last month I actually received the contribution, so it's in mixed. Now, when I actually give you a percentage, it can only give you the percentage for the 7 months, excluding the 5 months deemed segregated period. So if you click next, so the percentage will be 13.277, and it will also specify how does it apply. It applies from 1st July 2017 to 31st December, and then from 1st June to 30 June. So you still only get 1 percentage for the year, but it will take into account the period once in full accumulation phase. Okay, that's my case study number 3. The last case study is slightly more complex. So let's go to the class. So this is the Piggy Super Fund with 2 members, Pepper and George. Now what happened is in this fund, I already run a pre-update to end of financial year, as you can see. 30 June. Okay, let's have a look what the exception reports. So the exception report should display a lot of warnings or errors to do with this incorrect period update. It will tell you that during the year, 2 of the TRIS account has converted to retirement phase. One is for Pepper, so she turned 65 on 1st January, and the other one is for George. He turned 65 on 1st of March. In addition to that, the fund also changed the method from unsegregated to deemed segregated, and therefore you need to rerun pre-update to reflect those changes. So let's do that. So this fund, 2-member, 2 TRIS, Pepper's got $1.2 million in her TRIS, and George got 800,000. So as they turn 65, class will prompt you to run pre-update to the day before the actual event. So the first pre-update is saying TRIS conversion to retirement phase income stream. Process that. Second period update. So this will prompt you to run to the 28th of February. So that's when George turns 65. So when you have 2 boundary condition event happen, one is TRIS conversion, the other one is the ECPI method change effectively to deemed segregated. The one about method change overrides TRIS conversion. So that the narration will be the ECPI method change. So if you process that, Then we do the final period update to the end of financial year. Now, just in relation to TRIS conversion. So I'll quickly show you that new functionality. This is predominantly for the T-bar reporting purposes. Okay. Now, the easiest way to access that information or to do is if you go to member console at fund level, select 2017-18 financial year. So there's two buttons to ask you to convert their TRISs. So we'll do that. So the first one's for Pepper. So her 1.2, or a bit higher now due to earnings, is 1.24, is converted to retirement phase. Then we do for George. Just refreshing. So I need to select George, submit that. So he's got about 800, now it's 828,000. Now, once you've done TRIS conversion, so obviously lodging T-bar records still is done at business level, but now we have a fund level T-bar console for you to see their records. As you can see, Pepper's got 1.24 for the TRIS conversion, and George has got 800,000 or 828. So you can include those two records to notify the ATO about the event-based reporting for the transfer balance account credit balance. Now let's go back to the fund. So I have run a period update to the end of financial year. I just need to go obtain my TRIS certificate. So once I obtain the certificate, I will show you how the ECPI numbers is calculated, as well as the fund expense apportionment. So the TRIS conversion question is answered yes, and the fund, both members under 1.6 is eligible to use segregated method, but they're not doing segregation here. So the way this picture, the diagram you see is the first 6 months, the fund is effectively in non-retirement phase. So both TRIS account is 100% in the non-retirement phase. Pepper turned 65, so part of her balance now become in retirement phase, and George still in non-retirement phase. And then when George turns 65, all the balance now is in retirement phase. So if we obtain a percentage, it's 14.568. So obviously, if I go through payment and completion, I'll get that percentage and the certificate. But for these purposes, I will just update that. So the start date is 1st July 2017. And put that percentage. Save. Now you just need to rerun the last period update. I'll just close that. Roll back. New. Process. Okay. The first thing I want to show you is the new improved fund expense pension exemption calculation. So if you use the class currently allow you 3 options. So one is based on ATO ruling TR 93/17, or if we want to use actual percentage, then it will be 14.568, or you can manually specify percentage should you wish to use. And you can see this calculation now break down into segregated period and unsegregated period. So the segregated period is 8,200, the ECPI income, and unsegregated period total income is 10,867. When you work out the ECPI is 14%, 14.56% times that number plus 8,200, and that's how you get your 9,782. That over total income is the portion we use for pension expense. So the exempt portion is 51, so you claim 1 minus that, so it's roughly about 49%. Okay, now how do I know the exempt current pension income is correct? So let's just quickly run this report. Remember the first 6 months, the last 4 months, so one George turned 65, the fund effectively become deemed segregated. So if I run the investment income summary report from first of March to end of summary, investment income. Wrong one. From 1st of March 2018 to end of financial year. Okay, the 8,200 is basically the ECPI income attributable to the segregated period. Okay, close that. The other thing I want to show you is the capital gain. Now, in this example, I sold 3 slots of NZ shares in 3 different periods. Obviously, the last period, when it falls into the segregated period, the capital gain should be disregarded. So as you can see, the NZ shares were sold, they made $2,000 discounted gains. The first 2 period was 1st of July, 1st of February. They're both in unsegregated period, so the income is included. But the last period, 1st of March, it became deemed segregated, the income completely disregarded. The other thing I want to show you is that because the NZ share had the notional deferred gains attached, as you sell them, the notional deferred gains are realized. They are $300 per slot. Now that $300 cannot be reduced by discounts or pension exemption factor, so the $900. Let's look at the statement, the ECPI calculation. Okay, so if we go to exempt current pension income, okay. So what I did is, if you're adding those 2 numbers together, so 10,186 plus the ECPI 9781, you should have your total income of 19,167. There's no assessable contribution made during the year, so you don't need to do any subtractions. However, remember the ECPI attributable to segregated period was 8,200. So if you subtract that, and also the 900 capital gain that you realize because the notional deferred gains realized, that one because cannot be reduced by ECPI, so you need to exclude for the ECPI calculation. So you subtract another $900 times by the pension exemption percentage, which is 14.568. Add back your 8,200 is 9,783, which is this number. So there's $2 due to rounding issues. So that's how you check your ECPI. You need to work out based on investment income summary report to firstly confirm the deemed segregated period, run your investment income summary report to work out the ECPI attributable to the deemed segregated period, then do a little calculation to work out exactly how how this ECPI is calculated. Lastly, I mentioned the tax return. So let's go produce a tax return. Okay, view tax return. So I want to quickly show you the question about the exempt current pension income, which is section A, question 10. So the ECPI number is 9781. Now the method, it's both because you're using both segregated and unsegregated method. Obviously you have got an actual certificate. So if you actually print this, for people who are familiar with ATL stationery, there's no box for both. To replicate that information, classes automatically tick those two boxes for you. So segregated asset method and unsegregated asset method. Okay, I'm going back to the slides now to quickly cover off the last few things. Just bear with me, close that. Okay, so I already goes through all the case studies, so I'll just skip those. Okay, additional functionality, sorry. The other two actual providers, Hangs and ASAP, once they are ready, class will switch on the integration with them, and then you should obtain the actual certificate from those two providers. There's an only issue to do with distribution tax statements. This is because when you process distribution tax statements, it's normally done at the end of financial year, usually 30 June. However, the distribution cash amount is done based on if it's quarterly, every quarter, monthly, every month, half yearly. So there will be two. Now, if they falls in and out the segregated and unsegregated period, then class currently cannot perform the tax allocation based on the tax statement number. The reason being is if the distribution cash falls into a segregated period, the initial income will assume it's fully taxable, but because it's in segregated period, then it's fully exempt. However, when a tax statement say, oh, that income is actually all tax deferred or tax-free income, then there's no way for class to correct that automatically. Now, we are aware of this issue, so at the moment you have to prorata tax statements based on the distribution that you received. However, we do have two possible solutions. One is short-term solution, i.e. when you process a tax statement event in class, we are going to give you a button to effectively prorata the distribution based on the tax statement number based on the distribution cash that you have already processed in class. So if it's full quarter, then you'll prorata that the full quarter amount. This is how the wrap providers do their tax statements. If you use the like of BT and Macquarie, then they will, if you have quarterly distribution, there will be 4 quarterly tax statements. So that's one way of addressing the problem. The other way is obviously we're going to improve the 30 June period update to automatically apply the net result in the last period update, kind of smooths out the tax effect so that when you report for tax purposes, they are correct. Lastly, as I already explained, that ECPI income calculation has become very complex, and therefore people want a report to easily to reconcile that number. So that's coming soon. Now, 5 things to take away. One is if you do have external super balance for a member, then make sure you update on the contribution cap details. Secondly, it's usually only one fund policy per annum, per year. It's always best practice to have one fund policy for each financial year, even if they are the same percentage and ratios. Review your exception reports for any warnings and errors. Review your actuarial certificate. Now it has a lot more information, particularly about when the period it's effectively deemed segregated and unsegregated. And run, like what I show you, run your investment income summary report to reconcile those numbers. And ultimately, you should work out exactly how ECPI is calculated in the statement of taxable income report. Lastly, review the fund expense pension exemption percentage, as well as using the new ECPI methodology. Useful references. So this one, I actually spent most of the time. There's a tons of information in this slide, pretty much linked to all the well-known actuary providers in this industry. They also run webinars and they written a lot of articles. So I highly recommend you attend one of them. The current one, for example, you can actually see the link goes to one of their videos, recorded video of the sessions. The article written by Act 2 Deemed Segregation Beginner's Guide is a very nice written article, and Heffron wrote a couple of nice blogs on this topic as well. Class Connect conference. So Class is holding a conference on the 16th to 18th of September at Sydney Hilton Hotel. We have a panel of well-known speakers. We have Dan Fleming. She's the new Assistant Commissioner on Self-Managed Super Fund. Meg Heffron will cover SMS strategies for the 18-19 financial year. Manly Dunn is doing a topic similar to this one, but more from an actuarial certificate point of view. Grant Abbott is talking about what happened if self-super fund members increase from 4 to 6, some of the strategies. Chris Cuff is covering the reflection on royal commissions and the likely changes as a result of that. And we have hosts of who's who from the self-managed fund industry, people like Peter Hogan, Aaron Dunn, Leanne Schulte, and Tracy Bestis. If that's still not enough to convince you to come to the conference, personally, I'm running a workshop on how to make most of TBAR administration class. So that's the end of my presentation. Thank you very much. And I will go through some questions if we have. Sorry about running over time. It is a very complex topic, and I'll just check whether I have got any questions. Okay. There's a question about how the fund expense is apportioned. So the whole ECPI changes predominantly, or the new interpretation, it's all to do with how the exempt current pension income is calculated. The existing framework to do with expense apportionment has not been changed. However, because the ECPI calculation is kind of changed, especially for the fund expense apportionment, we have to take into account the new ECPI calculation method. So the way Class has implemented those changes is that for the fund expense, it was still using the fund expense pension exemption percentage, whether it's the ATO formula or which is the TR 93/17, a true percentage or manual specified percentage. So you will use that, regardless whether the fund expense is actually incurred in a period when it's segregated or not. Some of the deductions, such as supervisor levy and insurance premium, are continually deductible regardless whether they're in pension phase or not. And lastly, the investment expense. So investment expense, if you're reading the ruling itself, it's kind of more closely aligned with the actual percentage. So what that means in Class is investment expense by default, you're using an actual percentage. If for the period when it's in deemed segregated, then that investment expense will effectively become non-deductible. Now, another question, if there are multiple period updates run for a fund due to switching ECPI calculation method in different periods, i.e. from deemed segregated to unsegregated, do we need to roll back all period updates to take up the final percentage? So the answer is no. So as I already illustrated in my case study number 4, provided you have performed the correct boundary condition period updates, the last period update, or i.e. the period update to 30 June, and then you get a true certificate, you just need to rerun the 30 June period update, and the system will perform the correct calculation based on different scenarios. Okay, some people saying case study number 4, there's a graph. So I'll just quickly go back. Okay. Yes, okay. This diagram, some people saying because the first 6 months are from 1st July to 31st December, the fund is effectively in 100% accumulation phase, or because both trees is in non-retirement phase. Shouldn't that percentage initially be 0, then it become actual percentage? So that's actually a good question. So the way actuary calculates the pension exemption percentage is based on average value of pension liabilities divided by average value of superannuation liabilities, excluding the value of any segregated liabilities over the financial year. So in other words, if it's deemed segregated, then the certificate percentage does not apply. However, there's no requirement or need for actuary to specifically exclude the period when the fund was in 100% accumulation phase. However, when they calculate the time-weighted balance, taking into account the first 6 months effectively is in 100% accumulation. So when they apply the percentage for that 8 months in my diagram, then the percentage was much lower, and if you remember, the percentage was 14.568. So they already take into account. So this means that for 100% accumulation phase and the mixed period from 1st January to 28th of February, that 2 months, they effectively share the same actual percentage, which is 14.568. Just quickly check any more questions. Okay, this is another question. So if the fund is in 100% pension phase, receives the contribution, and immediately use the contribution on the same day to start a new pension, do they still need an actual certificate? So I assume the pension is initially in retirement phase, and the member has met new cash restrictions. So if you receive the contribution, now in class there's an option to defer member tax. If by default, I think it's always deferring it, so you have to run pre-update to basically remove tax. But if you untick the box saying not deferring member tax, then the contribution tax will be immediately taken out when the contribution event is processed. So let's using 25,000 as an example. Then if you not defer member tax, the $3,750 will be taken out. So the net amount will be used to commence a new pension. So provided you do that and use the pension or use the accumulation balance, entire balance, excluding contribution tax, to start a new pension, then effectively the fund is still in 100%. So even you get actual certificate, you will confirm it's 100%. So In this scenario, you probably do not require it. But obviously, if a member has external balance outside of class and that push the overall total to balance over 1.6 million the year before, then you still need that true certificate. Even though that true certificate will ultimately confirm it's 100%, but in that scenario, you need it. Okay, that's end of my presentation and questions. So we will have the channel still running until probably 3:20, extra 10 minutes for people who want to ask questions online. And we will try to answer them individually or maybe after session as well. Again, thank you for your time and have a great afternoon.